Listen carefully. I am not talking about a normal market cycle, a temporary surge in silver, or another prediction that disappears when the headlines change. I am talking about a shift in wealth that develops slowly, hides beneath the surface, and then suddenly becomes impossible to ignore. Most investors are focused on price. They watch charts, they watch daily moves, they watch analysts debate whether silver can rise a few percentage points or fall a few percentage points. But that is not the real story. The real story is the structure underneath the system, and that structure is changing. You need to understand something important. Wealth does not move randomly, it rotates. Throughout history, capital has flowed from one asset class to another whenever the underlying conditions of the economy changed. Sometimes the transition was gradual, sometimes it was violent, but it always happened. The people who recognized the transition early preserved their purchasing power. The people who recognized it late paid the price. Right now, most people still believe the current framework is stable. They assume governments can continue borrowing indefinitely. They assume central banks can solve every problem with another policy response. They assume debt can keep expanding without consequence. But history has proven again and again that there are limits. Every long-term debt cycle eventually reaches a stage where obligations grow faster than productive capacity. At first, the imbalance seems manageable. Then it becomes noticeable. Eventually, it becomes unavoidable. We are approaching that phase now. Look around. Government deficits continue expanding. National debt levels continue reaching records. Interest expenses consume larger portions of public budgets. Financial markets remain dependent on liquidity injections whenever stress appears. These are not isolated developments. They are symptoms of a system carrying increasing pressure. And pressure matters. Because systems rarely fail when everyone expects them to fail, they become vulnerable when confidence remains high despite deteriorating fundamentals. That is why most people are completely blind to what is forming. They see stock indexes, they see economic reports, they see reassuring statements from policymakers. What they do not see is the growing gap between perception and reality. That gap is where major wealth transfers begin. I want you to think beyond today's market environment. Imagine a situation where investors gradually lose confidence in traditional financial assets. Imagine a world where purchasing power becomes a greater concern than nominal returns. Imagine a period where protecting wealth becomes more important than maximizing gains. What happens then? Capital moves, it leaves crowded assets, it searches for scarcity, it searches for durability. It searches for assets that cannot be created by policy decision. That is where silver enters the conversation. For years, silver has been overlooked. Many investors view it as secondary. Some dismiss it entirely. Others hold small positions but pay little attention to them. That indifference is important because major opportunities rarely begin with universal enthusiasm. They begin with neglect. They begin when the market has spent years conditioning participants to stop paying attention. Silver has endured exactly that process, long periods of frustration, long periods of sideways movement, long periods where conviction was tested. Most people interpret that as weakness. I interpret it differently. I see preparation. Markets often spend years building foundations before the next major phase begins. The foundation is rarely exciting. It is quiet. It is uncomfortable. It causes investors to lose patience, but foundations matter because they determine the magnitude of what comes next. You need to ask yourself a serious question. Are you evaluating silver based on today's conditions? Or are you evaluating it based on where the monetary system may be heading? Those are very different perspectives. If you focus only on current conditions, silver may appear ordinary. If you focus on long-term structural changes, the picture becomes much larger. Ray Dalio has spent decades studying debt cycles, monetary transitions, and the rise and decline of economic powers. One theme appears repeatedly throughout that work. When debt becomes excessive, adjustments eventually occur, not because policymakers want them to occur, because mathematics demands them. Mathematics does not negotiate. Mathematics does not respond to political preferences. Mathematics does not care about market sentiment. When obligations exceed sustainable levels, change becomes necessary. The real question is not whether adjustment arrives. The real question is how adjustment unfolds. Will it come through direct restructuring? Will it come through inflation? Will it come through currency dilution? Will it come through a combination of all three? No one knows the exact path, But history suggests that tangible assets become increasingly important during these transitions. This is why I believe many investors are looking in the wrong direction. They are searching for certainty. They want confirmation. They want proof before acting. But confirmation usually arrives after opportunity has already begun. By the time a wealth shift becomes obvious, the repositioning process is already underway. That is why preparation matters. Preparation is not about predicting every headline. Preparation is about understanding the structure. And the structure today is sending signals that should not be ignored. Debt continues rising, currency creation continues expanding, fiscal pressures continue building, confidence remains elevated. Those conditions do not last forever. At some point, perception changes. At some point, capital begins seeking protection. At some point, wealth starts moving from financial promises toward tangible scarcity. When that process begins, it rarely announces itself politely. And if a major wealth shift is approaching, the investors who recognize it first may find themselves in a very different position from those who wait for everyone else to agree. The reason this matters is simple. Most investors have been trained to think in terms of short-term performance. They compare quarterly returns, they compare annual gains, they evaluate success based on recent price action. But major wealth transfers do not operate on that timeline. They unfold beneath the surface long before the majority recognizes them. The signs are often visible, but they are dismissed because they do not immediately affect daily life. That is exactly what makes them dangerous. When a system accumulates enough imbalances, the eventual adjustment appears sudden, even though the underlying pressures have been building for years. Think about how confidence works. Confidence is one of the most powerful forces in finance. Entire monetary systems depend on it. Government bonds depend on it. Currencies depend on it. Banking systems depend on it. Markets function smoothly because participants believe the structure is stable, but confidence is not permanent. It must be continuously maintained, and maintaining confidence becomes increasingly difficult when debt expands faster than income, when obligations grow faster than productivity, and when financial stability depends on constant intervention. You need to understand the distinction between stability and support. A truly stable system functions without extraordinary assistance. A supported system functions because extraordinary assistance continues. Many investors confuse the two. They assume repeated intervention is evidence of strength. In reality, repeated intervention often signals growing dependence. The longer dependence continues, the more fragile the structure becomes. This is why wealth shifts can become so powerful. When confidence begins changing, capital reallocates rapidly. Money that spent years chasing growth suddenly seeks preservation. Money that pursued risk begins seeking durability. Money that ignored tangible assets starts paying attention to them. The transition does not require panic. It only requires recognition. Once enough participants recognize that the rules are changing, behavior changes, and behavior drives markets. Silver occupies a unique position within that environment. Unlike many financial assets, it combines monetary history with industrial necessity. That combination matters. Industrial demand provides a practical foundation. Monetary demand provides a psychological catalyst. When both forces operate simultaneously, market dynamics change dramatically. Most people focus on supply and demand in simplistic terms. They assume prices move only because more buyers appear. The reality is more complex. Prices also move because perceptions change. A market that was once ignored can suddenly become important. A neglected asset can suddenly become strategic. An overlooked form of protection can suddenly become essential. When that happens, valuation frameworks adjust, and valuation adjustments are often far more significant than ordinary market fluctuations. That is why I keep emphasizing the difference between a trade and a transition. Trades are temporary. Transitions are structural. Trades focus on timing. Transitions focus on positioning. Trades depend on short-term outcomes. Transitions depend on long-term forces. If a major wealth shift is forming, then the critical question is not whether silver rises next week or next month. The critical question is whether investors are prepared for a different financial environment than the one they have experienced during the last several decades. History offers countless examples. Periods of excessive leverage eventually gave way to periods of adjustment. Periods of monetary expansion eventually encountered limits. Periods of confidence eventually faced reality. The details changed. The countries changed, the institutions changed, but the underlying pattern remained remarkably consistent. Human behavior did not change. People believed conditions would continue indefinitely. They assumed existing trends would persist. They assumed policymakers could prevent consequences. Then the cycle turned, and when it turned, the assets that benefited were rarely the assets most people expected. That is the lesson many investors overlook. The future is rarely a simple extension of the present. Major shifts occur when assumptions break. What assumptions dominate today? That debt can expand forever. That deficits do not matter. That liquidity can always solve structural problems. That confidence can always be restored. Those assumptions remain widespread. But widespread belief does not guarantee accuracy. In fact, history often shows the opposite. The most dangerous assumptions are usually the ones accepted without question. This brings us back to silver. For years, silver has remained outside the center of financial attention. Large institutions devote limited coverage to it. Mainstream discussions rarely focus on it. Many investors consider it an afterthought. That lack of attention may be one of its most important characteristics, because when an asset is already universally loved, much of the opportunity has already been realized. When an asset remains ignored despite improving fundamentals, the situation is different. Potential energy begins accumulating. The gap between perception and reality widens. Eventually, that gap closes. And when it closes, the adjustment can be significant. I am not saying every prediction will unfold exactly as expected. No one possesses that level of certainty. What I am saying is that structural conditions matter. Debt matters, Curry dilution matters, fiscal sustainability matters, confidence matters. These forces shape outcomes whether investors pay attention to them or not. The challenge is that most people only recognize their importance after visible consequences appear. By then, the environment has already changed. That is why preparation requires foresight, not prediction foresight. There is a difference. Prediction attempts to identify precise outcomes. Foresight recognizes probabilities. Prediction seeks certainty. Foresight seeks preparedness. And preparedness becomes increasingly valuable as uncertainty grows. Today, uncertainty is growing. Economic pressures are growing, fiscal burdens are growing, monetary experimentation continues, global financial systems face challenges that cannot be solved through simple rhetoric. These realities do not guarantee a specific timeline, but they do increase the probability of significant adjustment. The investors who understand that possibility are not necessarily fearful. They are simply realistic. They recognize that cycles exist. They recognize that excess eventually encounters limits. And they recognize that wealth preservation becomes increasingly important during periods of transition. That is why the conversation surrounding silver extends beyond price targets. The larger issue is positioning for a world where confidence may become more valuable than yield, positioning for a world where scarcity may become more attractive than promises, positioning for a world where tangible assets regain importance. Because if a massive wealth shift is approaching, the opportunity may not come from predicting every market move. It may come from recognizing the transition before the majority sees it. And history suggests that those who recognize transitions early are often the ones who preserve and expand their purchasing power, while others struggle to understand what changed. Now consider what happens when the broader market finally begins to recognize these pressures. Not when analysts debate them, not when economists publish reports about them, but when investors themselves start acting on them. That is the moment that changes everything. Markets are driven by perception, but perception does not change gradually forever. There are periods when belief appears stable for years. Then there are moments when belief shifts rapidly. A single event can become the catalyst, a liquidity shock, a debt funding concern, a policy response that creates more questions than confidence, a sudden realization that the system requires more support than participants previously believed. The catalyst is rarely the true cause. The cause has usually been developing for years. The catalyst merely exposes it. That distinction is critical. Most people focus on headlines. They search for the event. They search for the trigger. They search for the moment that explains everything. But experienced investors understand that triggers matter less than conditions. Conditions determine vulnerability. Conditions determine resilience. Conditions determine how markets respond once confidence begins changing. and the current conditions deserve attention. Global debt remains extraordinarily high, government spending pressures continue expanding, interest costs continue increasing. Financial systems remain dependent on confidence in future stability. That confidence still exists today. The question is whether it remains as strong tomorrow, next year, or throughout the next phase of the cycle. This is where many investors underestimate the speed of wealth shifts. They imagine a slow process. They imagine gradual adaptation. They imagine years of warning before meaningful consequences arrive. Sometimes that happens, but not always. History contains many examples where changes that seemed impossible suddenly became obvious. Assets once ignored became highly sought after. Assets once considered safe became sources of concern. Entire investment narratives changed within remarkably short periods. The reason is simple. Capital moves quickly when confidence changes, and confidence can change much faster than fundamentals. Silver's position within that environment remains unique. Its market is relatively small compared with the scale of global capital. That fact alone has significant implications. When large pools of capital begin seeking exposure to a limited market, prices can react disproportionately. This is not speculation, it is basic liquidity mathematics. Large flows entering constrained markets create powerful reactions. The smaller the market, the greater the potential sensitivity. That does not mean the journey will be smooth. In fact, volatility should be expected. Volatility accompanies nearly every major transition. Old assumptions resist replacement. Established narratives compete with emerging realities. Investors experience uncertainty. Conviction is tested. Many participants abandon positions prematurely because short-term turbulence obscures long-term trends. That pattern has repeated throughout financial history. The crowd often becomes interested near the end of a move rather than the beginning. They seek certainty, they seek validation, they seek reassurance. By the time reassurance arrives, much of the opportunity has already disappeared. This is why I continue returning to preparation. Preparation is not exciting. Preparation rarely receives attention. Preparation often feels unnecessary before a transition occurs. But after a transition begins, preparation suddenly appears obvious. That is the paradox. The actions that create resilience are usually least appreciated before they become necessary. If Dalio is correct about the scale of structural pressures developing within the global financial system, then the implications extend far beyond silver alone. They affect currencies, they affect bonds, they affect equities. They affect purchasing power. They affect the way wealth is stored and protected. Most importantly, they affect the assumptions investors rely upon when making decisions. Assumptions matter because portfolios are built on them. If assumptions remain valid, portfolios perform as expected. If assumptions fail, outcomes change. Many traditional investment strategies were developed during periods characterized by declining interest rates, expanding liquidity, and rising confidence. The future may not resemble that environment. That possibility deserves serious consideration. You need to ask yourself a simple question. What if the next decade looks fundamentally different from the previous one? What if preserving purchasing power becomes more important than maximizing returns? What if tangible scarcity becomes more valuable than financial abundance? What if confidence itself becomes the most important variable? These questions are not hypothetical exercises. They are practical considerations because every major wealth transfer begins with changing answers to those questions. The investors who prepare for changing conditions gain flexibility. The investors who assume nothing can change become vulnerable. That has always been true, and it remains true today. The message is not fear. The message is awareness. Fear produces emotional decisions. Awareness produces informed decisions. Fear reacts to headlines. Awareness studies structure. Fear focuses on uncertainty. Awareness focuses on probability. The distinction matters because structural shifts do not require panic to occur. They simply require reality to assert itself over perception. When that happens, capital adjusts, markets adjust, valuations adjust, and wealth redistributes accordingly. This is why I believe the conversation surrounding silver should not be limited to price alone. Price is only the visible outcome. The deeper issue is the environment creating that outcome: debt saturation, monetary expansion, fiscal pressure, eroding purchasing power, changing confidence. These are the forces shaping the landscape. Silver simply reflects them. Just as a thermometer reflects temperature without creating it, Silver reflects monetary conditions without causing them. The movement comes from the system. The asset merely responds. That is why understanding the structure is more important than debating short-term fluctuations. Short-term fluctuations are noise. Structure determines direction, and the structure suggests that significant adjustments remain possible. Whether those adjustments unfold rapidly or gradually is impossible to know. Whether exact targets are reached is impossible to know. But the underlying forces are visible. The pressures are visible, the imbalances are visible, the opportunity lies in recognizing them before recognition becomes universal. Because once everyone sees the shift, it is no longer an emerging trend, it is an established reality. And established realities rarely offer the same advantages as early understanding. The real question, then, is not whether silver attracts attention in the future. The real question is whether you recognize the possibility of a massive wealth shift before the majority does, because history has shown repeatedly that fortunes are not usually made when opportunities become obvious. They are made when structural changes are recognized early, and if the forces now building beneath the global financial system continue strengthening, the investors who prepare today may look back on this period as the moment when the next great wealth transfer was already beginning.